Hello, I am back in Washington State hosting an event at the Robin Hood Village Resort. I'm going to be down there for the next week working on the final phase. I finally bought out all of my partners on this deal, so that $4.5 million seller finance resort is now officially an Osgood only project. So as we finish that out, I'm celebrating with a whole bunch of friends at an event here. Now, on today's video, I'm going to share how to avoid or get over analysis paralysis. I talk a ton about deal structure, about finding deals, negotiating deals. The number one thing where people actually get stuck, though, is they get stuck on the one strategy they need to close the deal, or that one metric that's not quite perfect. The lack of certainty makes it impossible to submit an offer. However, if you knew with 99% certainty that when you close this deal, you'll have day one cash flow and you will make a lot of money on this deal, you can write that offer. If you're not that certain, I want to break down the actual steps so that as we enter 2026, you are ready to go and buy a ton of real estate like many members of Multifamily Strategy do. By the way, if you're not part of the group yet, it is completely free on Skool, Skool. There's a link below, a community of thousands of people who get together, talk real estate, share ideas, share deals. And if you're looking for people to fund your deal, a lot of them live there too. So if you're already on a free YouTube video, might as well go there, join the group, Multifamily Strategy Community on Skool. Like all of our information products, completely free forever. Go there, free calculators, great community. We'd love to see you there. All right, let's get cracking. So how do you actually get over analysis paralysis? What are the real steps? The first thing you need to know is that when you write an offer and you get an accepted offer on a deal, you're starting due diligence. You don't have to know everything. You have to have a good idea about why you believe that the numbers that you're looking at are likely accurate. One thing I do promise you, when you're under contract and you're doing your financial and physical due diligence, you will find things that make the deal look different than when you originally started. Sometimes it's better, sometimes it's worse, but my encouragement to you is that it will never look exactly like it does when you write that offer. So you are never, there is no circumstance where you are going to be 100% confident, nor is anyone else who writes an offer and gets an accepted offer. You are competing for what you believe is likely true. When you go under contract, you have a long period of time, weeks, to determine if your assumptions were accurate. So the first encouragement I have, and the most important thing, do your basic analysis, know your analysis of the property. There is a free calculator you can use in Skool to calculate all of these. But at the end of the day, I need to know I will have day one cash flow with the deal structure that I came up with. Do not buy cash negative deals. Have your income higher than your total expenses. A good rule of thumb: if you're cash flowing 8% cash on cash, which simply means if I put $100,000 into a deal, it yields $8,000 a year after I pay all of my expenses, the mortgage, the operating expenses, I have $8,000 of cash flow left over. That's a decent starting point. Any less than that, and I have to have a whole lot of upside or a very specific reason why I'm going to do that deal. I'm looking for a minimum of about 8% or a clear path to rapidly increase it, never starting with negative cash flow. So that's our first parameter. The next thing that we look at, and really the only other thing I care about, debt service coverage ratio. To get a property into bank financing, even if I bought it with seller financing today, I need a path to get out of that debt product if I need to for any reason. Banks want to see this ratio at 1.25 or higher, so I look for that when I go into a deal. All that means is you're basically, your total cash flow in this deal, the amount of income that you have enough to pay your expenses, pay your mortgage, and whatever else you have in proportion to your mortgage is additional to the DSCR. So example, I have a $1,000 mortgage on a property, and my total income on this property at my net operating income is $1,500. I can pay my mortgage and pay myself half of a mortgage. I have a DSCR of a 1.5. You want to have that extra cushion of at least a quarter point. And when you stabilize your deal, when you finish your project, you should hold it at a 1.5 or above. Why do banks love this metric? Because it's a true cash flow metric. It includes all of your operating expenses and your mortgage. It says after you pay all your bills, how much money is actually left over. What this lets me know is, one, I am definitely cash flowing, but two, I have options to swap my debt product if I need to. So now going into a deal, I found a property that I like. I think I understand the seller's motivation. I'm writing an offer that's going to get them a win and get me a win. I'm looking for cash flow and I'm looking for margin, that DSCR 1.25 or higher. I believe I have found it. I am now writing an offer, and if I correctly identified what the seller wants, we go under contract and we start our due diligence. In due diligence, you're going to do a financial due diligence and a physical due diligence. You're going to do an inspection, and you're going to review the bank statements, the leases, and make sure that everything maths out correctly. So your leases should match the bank statements, should match the rent roll, should match their P&L or their T12, their trailing 12-month financials. That doesn't actually take that long to do. You just want to make sure, hey, when we add up all the incomes, they match what we were originally presented. When we add up all the expenses, they match what were originally projected. Now we have a real set of financials. We get through due diligence. We finalize that piece. If you have a good deal, and a good deal, I mean a deal that it cash flows, has upside, has margin, you can raise capital for that deal. You can close with your own money. You can close 100% finance. There's a million ways that we talk about on this channel to close a good deal. But when you verified that you actually have a solid deal, an income-producing piece of real estate where you can make money on this for either yourself or yourself and investors, you are now ready to start the closing process. Whether you're going through bank financing, you're going to check their boxes. If it's seller financing, you're ready to go sign on the dotted line and close the deal. The simplicity, though, people get bogged down thinking they need to know everything before they go under contract. And you don't. You need to know enough to make an informed decision. And then you have weeks and weeks and weeks to prove that your assumptions were either true or false. So you need to throw your hat in the ring. If you believe that you have a good set of assumptions or enough data, go ahead and write the offer that makes sense with the data you've been presented. If anything changes, you can get that money back, whatever you put in earnest money, you can get that back for any reason or no reason at all. That's standard verbiage for any contract. So don't overstress your analysis at the beginning. Do a solid analysis, get a second set of eyes if you're new on this, run it past someone who's done this in your same market. Get a second opinion. If it looks good, go ahead and don't get scared. Write that offer. Once you're under contract, you get serious. Most deals that go under contract, most of them do in fact close. So once you start that journey, that accepted PSA is a huge step. And you are already now more than 50% likely, statistically, to close on that deal. Keep it that simple. You find the deal. You work the debt product. If your numbers look good, you have cash flow and DSCR, you find the equity, which is your down payment from either you or other partners, or sometimes you have a deal that doesn't even require any money down and you just close it out as is. Lots of ways to do this, but don't get overwhelmed or bogged down. People get frustrated with the cap rates, which are going to change after you buy the deal. You're going in cap rates, not your exit cap rate. Market cap rates are also subject to change. Throw out the alphabet soup of stuff and focus on the main thing. You are buying income, and you're buying income with margin. If you can do this consistently, you have the steps that you need to start buying a deal. The last piece of math you need to do is you do your going in math. Here's where we're starting. Where are you headed? How long is the debt product you negotiated? Do you have a partner that you're buying out later? At the end of your current structure, either the debt or the partnership, where do we anticipate conservatively the deal is going to be? You need to answer, how do I buy it? How do I never lose it? You need to have a plan of, how am I going to get this into new permanent debt? How am I going to hold this property? Your sole goal, this is all you're trying to do. Find that cash flow, which is what we covered in part 1 of this. Part 2, make sure that you never lose it. You just gave yourself a raise. For most of us, cash flow is the goal. So we've taken a step towards our goal. Let's make sure we don't lose this or have to sell it later to make the deal make sense. Do our day one math, do our exit math whenever we're exiting from either the debt or our existing equity stack. That's our partnership if we brought other people along. Once we get to that point, how do you hold it? What are the financials going to look like? And what debt products do you intend to move into, or do you intend to pay off the property? That's your entire process. If you keep those steps in order, deal, then debt, then equity, going in math, exit math, you're good to go. If you want a calculator to rapidly analyze any of these properties, link below. It's in the school community. You can go right into the classroom there, download the calculator that me and all of my students use as a first look. It is used in my mentorship almost exclusively. I offer it to you, like everything informational, for free. That is a tool for you. Click the link below, join the school community there. I hope this was helpful. If you are stuck on analysis paralysis, just know you will not know everything before you get a deal accepted. That's the most important thing I can share. Be confident enough to write the offer. Know enough math. And if you're not there yet, get a second opinion from any other investor who has done deals in that market. If you can get your confidence high enough to at least go under contract, now you can start actually proving your assumptions. And if they prove to be true, you're now ready to start the closing process. That is all there is to this. Once you do it once or twice, it's just as easy or easier to do it another 10, 20, 30, 100 times. Hope this helps. Let's go buy a ton of real estate here in 2026. I'll see you on the next episode.